There is a strange phenomenon in our modern culture where we equate activity with progress. We've been trained to believe that if you aren't constantly moving, adjusting, or pivoting, you're falling behind. In the world of finance, this manifests as a frantic search for the edge. We look for the next tech breakout, the undervalued crypto asset, or the sector that's about to explode. We spend hours reading headlines, watching tickers, and listening to people who claim to have a secret map of the future. But if you look at the data, real, historical data, you'll find something uncomfortable. The most successful investors aren't the ones with the most information or the fastest internet connection. They are often the ones who are, by all modern standards, incredibly boring. The hidden mistake most of us make isn't that we pick the wrong stocks. It's that we refuse to be dull. We treat our wealth like a high-stakes game of poker, when it should actually feel more like watching paint dry. Let's look at the math, because numbers don't have egos. Imagine two people, Alex and Sarah. Alex is an active investor. He follows the news, he hears about a promising EV company and moves $10,000 into it. 6 months later, he hears it's plateauing, so he sells and moves into an AI ETF. He does this 3 or 4 times a year. Even if Alex is right and manages an 8% return, he's fighting a silent war against two enemies, taxes and transaction costs. In many parts of the US and Europe, every time Alex sells for a profit, he owes the government a percentage of that gain. If he's in a high tax bracket in Germany or California, that win is immediately diluted. Now consider Sarah. Sarah buys a broad market index fund, something that simply tracks the top 500 or 1,000 companies in the world. She puts in her $10,000 and does nothing. Over 20 years, even if their gross returns were identical, Sarah ends up significantly wealthier. Why? Because her money never left the market. It compounded in a straight, uninterrupted line. Sarah didn't need to be a genius, she just needed to be disciplined enough to stay bored. If you trade just 4 times a year and lose a fraction to spreads, fees, or taxes each time, you aren't just losing that cash today, you are losing the future compounding of that money. Over 30 years, that small activity can cost you hundreds of thousands of dollars. If the math is so simple, why is it so hard to do? Psychologically, we are wired for the hunt. Our ancestors survived because they reacted to movement in the bushes. In the 21st century, the movement in the bushes is a red candle on a stock chart or a breaking news alert on your phone. When we see a stock we own go down by 5%, our brain processes it as a physical threat. We feel an urgent need to do something to stop the pain. Conversely, when we see a neighbor making a quick 20% on a speculative asset, our dopamine receptors fire up. We feel like we're missing out on the kill. This is the complexity bias. We believe that complicated problems, like building $1 million portfolio, require complicated solutions. We feel guilty if we just set an automated transfer and go for a walk. We feel like we haven't earned the wealth if we didn't sweat over the decision. The industry knows this. Trading platforms are designed like casinos, bright colors, haptic feedback, and top mover lists. They don't make money when you sit still. They make money when you are excited or when you are afraid. If you ignore this and continue to chase the thrill, the impact isn't just financial, it's cognitive. When you are an active, exciting investor, you are constantly spending your most valuable asset, your mental bandwidth. You are checking your phone at dinner. You are stressed during your commute because the markets in Asia opened lower. You become a slave to the now. Financially intelligent people, the ones who actually build wealth, view money as a utility, not a hobby. They understand that the stock market is essentially a mechanism for transferring money from the active to the patient. They behave with a quiet discipline. They automate their savings. They choose diversified, low-cost funds that cover the entire economy, not just one sector. And then they stop talking about it. They spend their time perfecting their craft, deepening their relationships, or improving their health. They let the world's most productive companies work for them while they go out and live. They realize that if your investment strategy is the most interesting thing about you, you're probably doing it wrong. Building wealth is a slow, unglamorous process of waiting. It's about accepting that you don't know what the market will do tomorrow, but having a rational expectation of what the global economy will do over the next 2 decades. The boring investor isn't someone who lacks ambition. They are someone who has the humility to realize they cannot outsmart millions of other participants and the discipline to let time do the heavy lifting. If you find yourself constantly checking your portfolio or feeling the urge to fix your strategy every time the news changes, it might be time to step back. The most powerful thing you can do for your financial future is often to do nothing at all. Wealth is quiet. Poverty is loud. If you found this perspective useful, feel free to subscribe. We'll talk again soon.